Everyone loves Tom Lee, and in fact, it's quite evident to the point where he been elevated to this demigod status at this point. And demigod or not, I'm here to prove to you that, in my personal humble opinion, Tom Lee has been skipping leg day, and only those who will stay all the way throughout the video will understand what do I mean when I say I think he's been skipping leg day, demigod or not. First of all, we need to consider that at this point, everyone is waiting for Tom Lee to appear. Doesn't matter whether we're talking about CNBC, whether we're talking about Bloomberg, and it is almost unproportional to the point of how much weight his influence merely by appearing on television and saying what he thinks his thesis is, and how much that overweighs on the market within itself. Now let's start off of this posting just recently by Tom Lee himself. Overall, I still view the recent weakness as being a minor pullback in many sectors, including technology, and not a start of a larger sell-off. So it's pretty conclusive that regardless of everything that recently has been happening in the market, Tom Lee is still very, very bullish and does not forecast anything but a minor retracement in the market, right? And that is where I'm starting to suspect that Tom Lee, probably being at the foot of the mountain, does not recognize what is actually happening at the mountain peak, and slowly this avalanche is being built up. So Tom Lee is looking outside his window, doesn't hear nor see any avalanche, and does not recognize what is coming. It could be that he's not recognizing, or maybe that it's beneficial for him not to recognize, so to speak. Now, my argument here is actually very simple. I'm thinking either that Tom Lee is ignoring technical analysis altogether, or at least not applying it, or maybe it actually benefits him to have this double speak and project to you guys something completely opposite of what he's seeing. That's a whole different debate, but for right now, I want to do a couple of very simple things. First of all, I want to show, I understand that sometimes if I do present some of these charts, these look very, very excessive and almost impossible to read, right? But that's what it takes to actually read and understand the market properly and not be surprised, not necessarily being dependent on the talking heads of the media to tell you really what is going on in the market. It is very difficult. That's the leg day of the market. He's either skipping leg day, or he's actually far more ready for this marathon than he's leading you on to believe that he is. Now, at this point, I want to take a little bit of a sideways, to sidetrack a little bit. I want to show you here 1.5 minutes from a video that I've made 12 days ago, right? This video is about NVIDIA, all right? This video is from the date of the earnings, right? Currently, the price is 107 in pre-market. We've seen the market just a day ago test this 100.95, let's call it a 100 range, basically, which I also projected we will be retesting again and again and again, the same way we've done it on the way before. We're gonna do this again, but I want to show you this little 1.5 minute video clip from my own video, as we said 12 days ago, talking exactly about that. So now I'm gonna be quiet. I'm gonna let you watch this for a sec. But we were looking at, let me show you. There is, well, first of all, to continue breaking downwards, we'll have to break through that 110, okay, 110.67 to be super precise about it. Of course, we have the psychological 100. It's actually far stronger than people realize. It is a very strong support and resistance, so we're going to see how that breaks. If 100 breaks in the short term, even without testing back and forth from the 100, 110, basically look at this like a minefield. It's almost like you have a very wide minefield between this, and subsequently this and this, which is a part of the golden pocket on the Fib retracement on the previous cycle, starting in 2008 on NVIDIA individually. In other words, what we are looking here is, as usual, at 3 levels: S1, S2, S3. S1 is going to be 110. S2 is going to be 100. S3 is going to be a range, which is basically this. So S1, S2, S3. All right, I think that's more than enough, so you get the idea. Those who know how to use technicals, and even in their simplest form, can actually forecast and see what the market is showing, right? I want to go back to the market right now and forget about this chart, because this is for students of mine, people who really want to go in depth on technicals and actually want to learn and be able to analyze the market and be able to see it in its simplest form, as basically I've been doing lives throughout this entire process, covering anything from Nvidia to Palantir to Tesla to Apple and the S&P, the overall indices, of course, showing exactly how, if you do it right, you can predict the market, of course, to a limited extent. No one is trying to time the market as much as we are forecasting particular movements, if they're harmonics related, other tools related, basically, again, all based in technicals. And if you do it right, you can actually forecast what we're seeing. One of the most scarier things, something I've been talking about all along, and why I'm actually forecasting somewhere around the 44% retracement. It could be around the 42, 41. Again, it could vary. Right now, forecasting the price action dropping to the range of 30. Well, actually, to be super precise, we're expecting the price action to drop subsequently, eventually, when it does, below this level, below this very, very particular level, the 3491.58, right? But that is visible only when you actually apply proper technical analysis, even if you apply it in its most basic form. Now, I will add and say something that people get something very, very wrong. And I say this in the community all the time. The technical tools are not just useful for day traders or just swing traders. This is where actually technical analysis tools are required for even the so-called investors or the long-term traders, right? The people who are planning out 10 years, 5, 7, 15, doesn't matter, anything that is actually longer term duration, right? These tools actually allow you to analyze when is the right time to start DCAing. Is it the right time? Should you maybe tightening up your stop losses and take profits potentially to execute as much before the correction happens? Now remember, there is oftentimes people look at things in a very binary form, basically saying, well, I'm in or I'm out. No one says you have to. You can actually execute a certain percentage. If you are already sitting at what is very close to your initial investment with very significant profits, you might as well consider withdrawing your original investment, which will allow you then to function with the remainder of your actual profits in the market in a far more efficient and calm way, which you will then be subsequently a lot more effective, and more so you'll be a lot less worried, which will allow you to have better decisions. Think about it. When you're worried and anxious, you definitely don't make the right decisions. When you're not and you're in a clear head, you definitely make the better decisions. So that just simply makes sense. Now, after all this rambling, I really want to just show you what actually the problem is. The problem is something very simple. If we're looking at the 12-month chart, which signifies every single candlestick here signifies a whole year, 12 months. And this process of a correction or mitigation of the bull price action that people were expecting, right? In fact, right now is just that buildup, the potential process where we're starting to move to the downside. And if you follow my lives, you will see I've been covering this for some time now and saying exactly that we're slowly building up a very bearish wave, and you can see it coming throughout most time frames. For example, here it's a little bit confusing or misleading, and to understand why on the 6 months on a half-year chart, it actually is somewhat misleading. You should probably join my community. You'll have the link in the description below, of course. I highly recommend joining my Patreon. That way you can participate on our weekly Zoom calls. You can hang out with me pretty much on the daily basis on the Discord. In our Discord, we have right now 18,000 people, which let me just show you real quick. We are now one scratch away from 18,000 people, right? We have the public partition, and of course we have the members partition, the open forum, just like this. This is where I hang out throughout most of the day. Unless I'm on a one-on-one call, this is where I have the one-on-one call. Those who want to inquire about my Technical Analysis Academy, where I teach one-on-one how to properly analyze and come up with charts that are basically as such and allow you to really see these things far in advance, right? So right now, just to put it in simple terms and to give you some form of an idea of what I'm talking about, why the 3 months, the 6 months is not necessarily as bullish as you perceive, and for example, why the 3 months is not as bullish by the same thesis. The monthly, for example, is very bearish, so we're seeing a deep correction. I'm expecting to significant levels, as I said, subsequently leading to a correction all the way to the area of 3,300. Yes, it could be 3,400. It doesn't have to be 33, but with a certain marginal error, of course, or standard deviation of the 3,490. That is the area that we're actually looking for. And we can see that coming through in the technicals in the same way we were able to predict what was to come on NVIDIA, right? Even when you apply the really basic tools, you can actually come up with a proper analysis and see that what I'm seeing on the SPX is pretty much inevitable. So what Tom Lee is doing, he is either far more prepared for this marathon than he's leading you to believe, right? Or he's really not doing his leg day at all, skipping leg day, and he's not prepared and he's not aware of the technicals that are basically screaming and glaring at this point of a very deep crash. Let's call it what it is. This is going to be a deep crash. This is not a correction, it's a crash. But does that mean the market is doomed? No. That's going to be probably the best time to learn technicals, to be able to properly recognize when you should be starting to DCA into the market, so you'll make the most out of this movement. This movement is so rare. In fact, I would argue we haven't seen this type of movement since between 2008 and 2009, if you will. This is basically the equivocal of this movement. Here it is. The secret is out. We are seeing this particular correction or crash, as should be properly named, the equivocal of what was happening during the prime real estate housing crash, if you will. Now, we are talking again something, just to put it in terms that make sense to the average viewer, we are talking about more than 53% at the time, 53% correction to the downside. And this time around, my argument that we're merely going to correct around the 44%. Let me just kind of show you from the top to the area where I'm forecasting. All in all, in fact, it's less. It's around 41.29% as for the time of this recording, right? This is how it seems. Of course, maybe I've kind of missed there a little bit on the top, but you get the idea. It's around the 41, 42%, maybe potentially up to 44, of course, giving some slippage. So now that you know this, of course, you should manage and handle and prepare your portfolio the way you deem necessary. This is all I had to say, and I hope to see you in the community. You all have a wonderful week. Bye-bye.